Millions of Americans earn income through 1099 work. Contractors, gig workers, influencers, realtors, consultants, small business owners. You generate real income, real cash flow, but when you walk into a traditional bank, you hear the same story. We can only use what's on your tax returns. Sorry, you don't qualify. Well, today we're going to fix that. If you receive 1099 income, then this episode's for you. Welcome to the SCI podcast. We are dedicated to those who are self-employed and looking to purchase a primary residence or build your real estate portfolio. In today's episode, we're going to break down how to utilize the 1099 non-QM loan program. So think about the QM space, which we've talked about. A traditional mortgage is going to qualify based on your W-2 income, your pay stubs, or if you're self-employed, it's going to use your most recent 1 or 2 years tax returns. And that number that shows as your gross adjusted net, or the income that you report as taxable to the IRS, is what the bank or lender is going to use to derive what your qualifying income is. Well, more often than not, if you're self-employed, you're showing a much lower number than what your gross income is. So here's a number. There's around 16 million Americans who are currently self-employed, but if you take that number and use secondary income, meaning you have an additional income source aside from your primary profession, that number is actually closer to 72 million. Because of that additional income, what's considered self-employed income as far as the bank's concerned, it becomes challenging to qualify for a traditional loan. That is why the 1099 loan program in the non-QM space was created. It's leveling the playing field and giving you an opportunity to derive your qualifying income from another method than your traditional tax returns. So let's peel back the curtain a bit on how this income is calculated. When you're looking to use the 1099 loan program, you're either going to provide your most recent 1 year or 2 years 1099 statements if you have multiple sources of income, and then we're going to apply an expense factor to that gross 1099 income, and from there, we're going to divide that number by 12, and that is what your qualifying income is. There's no tax returns, there's no W-2s, there's no pay stubs. However, if you're in a profession where this is a second form of income for you, you can still use your W-2 income and combine that qualifying 1099 income without providing your tax returns. So let's just think about that for just a second. If you've ever tried to purchase a home before and you receive 1099 income and the banks told you no, it was likely because the qualifying income that they're able to use is what was reflected on your tax returns, and that number was much lower than what your actual 1099 statement is that you received for those previous years. So here's an example of what your 1099 qualifying income would look like if you were using this non-QM product. Let's say that you made $140,000 in gross income for the previous year's wages earned. You would take, on average, a 10% expense factor, meaning we're going to remove 10% of that gross income and leave you with 90% of the remaining 1099 income earned. So at a 10% expense factor, that's $126,000 in qualifying income, which breaks down to $10,500 a month. So you can see, if you were to go to your tax returns right now and look at your 1099 and then go to your gross adjusted net and divide that number up by 12, I would be willing to bet that the 1099 at a 10% expense factor, meaning you're using 90% of your income, that number is going to be much higher than what your average was if you were to divide out your gross adjusted net from your 1040s. And this is for any 1099 income. You could be a real estate agent earning commissions. You still hang your license with another real estate brokerage, but they issue you a 1099 at the end of the year. A gig worker, delivery drivers, consultants, freelancers, small business owners, contractors and builders, creative professionals, digital entrepreneurs, social media influencers, anyone transitioning from a W W-2 to now a 1099, you're considered self-employed, and this loan product could be a vehicle for you for financing. So let's break down some more examples of professions that would fit inside this 1099 non-QM loan. So let's say you're a gig worker and you earn around $8,000 on average a month, which is around $96,000 in gross income. But on your tax returns, your qualifying income only reflects $30,000, which is around $2,500 a month. Well, if you use the 1099 loan program, you would simply take that $96,000 that's listed on your 1099 and at a 10% expense factor, that's a qualifying income of $86,400 annually, which is around $7,200 a month. So would you rather have $7,200 a month in qualifying income or $2,500 a month in qualifying income? And let's look at what that would translate to. At $2,500 a month in qualifying income, assuming you had no other bills, meaning you have no car payment, you have no credit card bills, you have no student loan bills, there's nothing else reporting on your credit as a monthly expense, and you were able to use that full $2,500 in income towards purchasing a property, that would be a home of around $175,000 if you were to put 10% down payment. Whereas if you were using that $7,200 a month, that would be a home of over $500,000 at a 10% down payment. It makes a massive difference if you're able to actually use the income that you've earned in order to qualify for a home, right? So here's another example. You're a digital creator and you make $15,000 a month in gross income, and your 1099 reflects $180,000, but your tax returns or the income the bank was able to use as qualifying income from your tax returns is around $60,000, which is $5,000 a month. If you were to use the 1099 loan program at a 10% expense factor, that's $162,000 in qualifying income, which gives you more like $13,500 a month to use towards your house. So you can see that's just another example of how the 1099 loan program is created with the self-employed borrower in mind. So now that we've taken a look at how the qualifying income is derived from the 1099 loan, there's a few things that you need to be aware of if you're going to use this loan product. Like a lot of other non-QM loan programs in this space does have a minimum requirement of a 10% down payment, meaning you can't utilize some of the other lower down payment options like the first-time home buyer, FHA, where you're at 3.5% down, or there's additional programs we offer where you can essentially go above 100% financing and receive credits towards your closing costs as well. But keep in mind, like some of the other non-QM loan programs, even if you're putting 10% down, you won't have monthly mortgage insurance, meaning that your principal and interest payment is what's calculated in addition to your taxes and insurance, and that's your total payment or total qualifying payment that the bank's going to use to calculate your debt to income ratio. And there is a debt to income ratio on the 1099 loan product as well. Typically, you want to stay within that 50% debt to income ratio. There are investors that will go higher than 50%, but there has to be a lot of compensating factors, meaning you have a very strong credit score, you have a lot of reserves to show that, hey, if business changes or adjusts slightly, I still have the means to make my mortgage payment, because just like all other non-QM products, you also still have to meet the ability to repay rule like we've talked about in other episodes. So quick recap, you can utilize as low as a 10% down payment. This program can be used for purchasing your primary residence, a second home, or even an investment property. This loan program is a very good fit if you receive 1099 income from your profession. In addition, if you have W-2 income that you earn from another line of work, or maybe your 1099 income is your secondary income, you can combine that income into your 1099 and use the total as qualifying income. For example, if you make $100,000 at your W-2 job and you made $50,000 freelancing on the side, that would give you $100,000 in gross income and 90% of the $50,000 for your total combined income. So why that's so important to mention is because if you're using a traditional QM loan, they're not going to use 90% of your 1099 income. The only income that you're able to use is what is available after any tax deductions that you've claimed on that 1099 income. So for example, if you gross $50,000 in 1099 income and you wrote the majority of that income off and you're only left with $5,000 in taxable income from that $50,000, you would only have $105,000 in total income because you had your $100,000 W-2 and $5,000 left from your 1099. Or potentially even lower, if you wrote off all of your 1099 income that you earned and you took a loss on that income, meaning you had so many deductions available to you that you didn't have any taxable income on the $50,000 that you earned, and you had a $10,000 loss, guess what? That $100,000 in gross wages that you have is now only $90,000, right? It has to take into consideration all of your deductions that you took on your personal tax returns. So you may have earned $150,000 in income, but as far as the bank's concerned on what they use for your qualifying income, in this example, you wrote off the $50,000 and you took a $10,000 loss, guess what? You have $90,000 in qualifying income left over instead of $150,000 that you started with, minus that 10% expense factor when utilizing the 1099 loan program. So this is just another example of one of the great loan products available in the non-QM space that favors the self-employed. Thanks so much for joining us on the SCI podcast. I hope this is another loan product that you could put in your toolbox. And if you want more information about this particular loan, head over to scimortgage.com where we have tons of tools and resources available, ways to calculate your income, and you can get in touch with us. We'd love to connect and hear about you and your business. And until then, let your money work smarter, not harder.